Good day, everyone. I'm Kale Zafropoulos of Capital Link, and I would like to welcome you to Capital Link's Expert Talk webinar series, a series providing expert insight on a variety of topics relevant to the shipping market. We are joined today by Dr. Nikos Papapostolou, Reader in Shipping Finance at the Costas Grammenos Center for Shipping, Trade and Finance, and Director of Masters in Shipping, Trade and Finance at Bayes Business School. Welcome, Nikos. Thank you for joining us. Today, Nikos will give us a presentation titled Snapshot of Public Shipping Companies. And with that, I turn the floor over to you, Nikos.
Good morning, Kayla from London. It is a pleasure to be with you today, and many thanks for hosting me on Capital Link Expert Talks. During the webinar today, I will focus on providing some key facts about public shipping companies and delve into a few preferences that investors may have when deciding to allocate capital to shipping stocks. Next slide, please. So let's kick off. Capital markets facilitate the transfer of funds from those seeking a return on their assets to those in need of capital to mainly grow, among other purposes. Recent figures show that a total of $7.7 billion has been raised by shipping companies through 90 transactions, with the US and Norway stock exchanges being the main facilitators for the provision of funds and make up approximately 70% of all deals. Further, as we can observe on the bottom right pie chart, companies operating in the container and dry bulk markets are mostly the end users. Next slide, please. Turning to who are the fund providers, we live in the age of the enabler, the enablement of financial services, or in other words, the democratization of financial services has opened new pathways to service previously underserved customer segments. It has broadened the access of an individual to financial products and services through newfound channels due to technology advancement and population shifts. What is the impact of democratization of financial markets? Probably the wealth creation globally. However, in terms of shipping stocks, one could also say has probably led to an increased demand for shipping stocks by retail investors. This is depicted by the gradual decline of institutional investors' participation since 2014, who recorded an exit from shipping stocks in the magnitude of 36%. During the same period, retail investors increased their participation by 47%, with the trend being more profound just after the pandemic. The sectors that stand out in terms of retail demand are the gas and the container and tanker sectors following thereafter. Notably, for the same period, as we can observe on the graph, the average number of analysts covering shipping stocks has decreased by 35%. This may be another impact of the democratization of financial markets via the growth of robo-advisory platforms where retail clients can receive personalized, data-driven advice and purchase financial products without the involvement of human advisors. Next slide, please. In terms of factors affecting the investment decision of allocating capital to shipping stocks, I will borrow this from our professor, Professor Grammenos, who has highlighted and discussed them back in 1995 and always delivered and still delivers in class to our MSc students. The decision to invest is affected by a combination of external, internal, and company-specific factors, and then investor preferences. In a brief attempt to educate investors, I will focus on the preferences of market standing, fleet age, gearing, and an internal factor, shipping versus other markets. Next slide, please. When referring to public shipping companies, investors should have in mind three words: big in market control, larger in size, and younger in fleet age. Only 4% of all companies control a quarter of the total market in deadweight tonnage terms, while on average, a listed company currently is 8 times larger in size by deadweight tonnage and operates a fleet which is 2.5 years younger than that of a private company. A similar picture can be drawn when we categorize the sample into the different sectors of the market. which is at the bottom of the slide. Next slide, please. Now, if we apply the same analysis on the most active markets of US and Norway, the big in market control becomes even bigger. We can observe that a smaller percentage of companies control a substantial portion of the market, ranging from 7% in the bulk carriers, LNG carriers and container ships, to 8% in chemical tankers, and up to 11 and 14% in the oil tankers and LPG carriers, respectively. Then, larger in size also becomes even larger. In the chemical tankers and LPG carriers, where a listed company is on average 20 and 11 times larger than a private company. And finally, younger becomes even younger in the sectors of oil tankers, LNG and LPG carriers, where listed companies operate a fleet that is on average younger by 4 and 7 years in comparison to private ones. Therefore, the message to get out there is the following. Investors who prefer companies with high market standing and a young fleet relative to the market can count on fulfilling that preference. Next slide, please. Let us now focus on the leverage of public shipping companies. It is apparent that currently companies are well positioned to cover liabilities while the debt levels have been reduced substantially. The net debt to EBITDA ratio assesses financial health and informs at the same time investors and creditors about the company's ability to meet debt obligations. Since 2018, a ratio of 7.6, which raises red flags and signals elevated risks for investors and creditors alike, public shipping companies have managed to bring that down to a ratio of 2, which is favorable and indicates a company's capacity to easily repay debts. And of course, we could also say that it means additional debt can be raised at favorable terms. The latter point can also be supported by the fact that companies have also managed to pay off existing debt and reduce their gearing level from 52% in 2020 down to 37% in 2023. Overall, companies operating in the container and tanker sectors stand out in terms of ability to cover liabilities and lower gearing levels. And these sectors are the ones recording the most reduction during the 2014 to 2023 sample period. Next slide, please. I will finish off by looking at the internal factor of shipping versus other markets and state that there is always money for good projects, and there are investors who are hungry for returns and ready to provide capital to the shipping industry. Since 2004, we can identify 3 different periods for shipping stocks relative to the market. High return and high risk for 2004 to 2007, very low return and high risk for 2009-2019, and very high return, moderate risk for 2020-2024. In terms of returns, the shipping index has outperformed the market in 2 out of the 3 periods. And it seems that the current run of the shipping index has not only exceeded expectations based on historical expected return, recording a cumulative return of 413% with an annual expected return of 36%, but we can also argue that the risk of shipping stocks is only moderately higher relative to market risk. Note that in the past, the shipping index risk was double the market risk. Certainly, this is an important development, since the risk-return profile may have an impact on the marketing of shipping IPOs, follow-on offerings, and on stocks currently trading on stock exchanges. Next slide, please. Overall, opportunities in shipping stocks always existed and will exist if investors acknowledge that shipping market volatility is always reflected on stocks and a thorough due diligence is always needed. For example, looking at the 2009-2019 depressed period for shipping stocks. Bargain hunting can make you money, provided that you do a thorough due diligence and pick up companies with sound financials, strong growth plan, and a ship owner behind the company with a significant stake in it, who also has a long-term view and utilizes the equity capital markets to diversify the company's capital structure. On the other hand, during the 2020-2024 prosperous period for shipping stocks, without a thorough due diligence, an investor would end up with underperforming stocks that also carry high risk. To wrap up, I hope the key messages discussed today are clear, and I should leave you with the following. It is apparent that the current risks globally are a combination of political, geopolitical, and economic risks, an outcome of structural changes that have been building over a long period of time. This, of course, can cause a headache to investors, as geopolitical risks are unpredictable, difficult to quantify, hence difficult to price them in, and eventually can trigger major economic and market events. Thank you very much for your attention.
Thank you, Nikos, for that insightful presentation. And thank you, everyone, for tuning in. Please look out for upcoming episodes in the Expert Talk podcast series, which will shed light on a variety of topics in the ever-changing and fascinating shipping industry. Thank you. Have a good day, Nikos.
Thank you very much, Kayla, and thank you for having me.